We just officially entered a stock market correction, and there has been a lot of selling these past few weeks. For the long-term focused investor, that means there could be some interesting buying opportunities. For example, in my own portfolio, one of my higher yielding dividend stocks is trading at its 52-week low. So I thought it'd be interesting to see if we can find even more high yield dividend stocks trading near their 52-week low. So I went and ran this stock screener looking for companies above a 3% dividend yield that are within 5% of their 52-week low. And I went through this entire list and found the top 2 best opportunities right now, in my opinion, and I'll give you a brief stock analysis on each. And if you stick around to the end of the video, I'll give a few honorable mention looks that you should take a look at and analyze yourself. With that said, let's roll the intro. My name is Zach, this is Dividend Data, and you should leave a like and subscribe to the channel if you enjoyed the video. Every month I give an update on my personal dividend growth stock portfolio, and throughout the week I'll do other stock analysis content, whether that's a full review on a company, like for instance I just did Google, or earlier this week when we started selling off big, I gave my top 5 overall stocks to buy at that time. That was focused more on lower yield, high dividend growth companies that I think are high quality. That's personally what I'm pivoting to more in this sell-off. However, I also own some high yield dividend stocks, and every once in a while there's a very good buying opportunity to optimize your dividend yield on cost and get some quality income with even some outperforming total return. So today I'm going to take a look at some of these cheap high yield dividend stocks right now. The first one I found that was interesting was Target Corporation, ticker symbol TGT. They are currently trading at their 52-week low with a 4.18% dividend yield. And if you want to use the stock research tools I'm showing throughout, it's all available at dividenddata.com. You can try it out risk-free as there's a 30-day money-back guarantee. And by the way, right now is a great time to join. We have a 50% off sale on the annual membership. That's the best price we ever offer. The link is in the description and pinned comment of the video. And this whole tool is basically designed to help you better invest and find better companies. And the cool thing about investing is if you do find just one better company, then it way more than pays for the use of the tool. So let's look at Target Corporation, ticker symbol TGT. So as you can see, this company peaked both in terms of stock price and earnings per share in fiscal 2021. And since the stock price has completely collapsed, and we are now near those 2023 lows once again. And this somewhat matches up with the earnings per share at Target. As you can see, it started to recover and then came back down. And ever since we saw that negative growth again, the stock has plummeted. However, this puts it at an interesting value. We have a 12 PE ratio based on earnings over the trailing 12 months. And as you can see, the stock already started trading this morning, so we're at a 4.2% dividend yield. And if we take a look at the dividend data for Target stock, you can see that this has been a consistent, reliable dividend payer with a history of annual dividend increases. They've been doing that for decades. The 10-year compound annual growth rate of Target's dividend is 7.97%. However, this has slowed down significantly as of late. You can see there was some big outlier increases in 2021 and 2022. And since then, we have been down to 1.85% dividend growth, and the most recent being 1.82%. And this dividend payment is pretty sustainable too, as you can see based on the earnings per share payout ratio, so net income. It is always in a sustainable range. This past year, it was 50%. And if we look at their free cash flow payout ratio, it is also usually always in a sustainable range. This 2025 data is an outlier, though. It just reported, so I think there's a bug. I'll get that fixed. And if I ask the AI analyst for some more details about their free cash flow and capital expenditures, you can see that they hit $4.4 billion in this fiscal year that just ended. That's up from 3.8, and they had a terrible outlier 2023 with negative $1.5 billion. If they can grow from this base, though, Target generates a lot of free cash flow for their current valuation. And the reason why free cash flow went up is they have been reducing their capital expenditures. They dropped that from $4.8 billion to $2.8 billion. So based on free cash flow, Target's dividend, which is $2 billion a year, that's about like a 40 or 45% dividend payout ratio. So the dividend is definitely safe, and it is trading at one of its highest historical dividend yields. It's the highest seen since that 2023 crash, and prior to that, since 2017, where Target was kind of trading at a steal valuation. But let's take a look at Target's recent earnings and outlook for this coming year to see if they're on a path for a potential turnaround and if the business is doing well. So for the full year, fiscal 2024, comparable sales grew only 0.1%, so basically flat. However, they achieved $2 billion in cost savings over the past 2 years. They also had strong earnings per share of $8.86, which was in line with their original guidance, so they have been hitting what they've been telling the market. And in this latest quarter, they just gave guidance for 2025, and here's what they said. They said they expect 1% net sales growth, so again, we're basically flat. They're expecting a modest increase in operating margin, and the more important metric with earnings per share, they're expecting on the low end $8.80 to on the high end $9.80. But there is some short-term trouble for Target and really a lot of big box retailers in the United States, and that is mostly around tariffs. And in their latest earnings call, they cited tariff uncertainty. And the reason this could impact Target is they source many different products to sell in their stores, and a lot of those are likely manufactured overseas. So they might have some inventory disruption and possibly have to raise prices on certain things. So for Q1 2025, they cited this as a negative thing over the near term. So that likely contributed to Target's recent selling over the past few weeks. However, even with that, they gave guidance that's not that bad. If they hit these metrics and grow from that in future years, then Target could be set up for a decent total return. Since 1990, Target stock has a total return of 3,722%. That was as high as 8,000% in 2021. Now again, the past 3 years and the past year has been bad for Target investors. But if you're looking at Target stock right now, you'd be buying it at these low valuations. You didn't buy it at higher prices. So for an investor who wants reliable dividend income and possibly even a market matching or market beating total return, Target at these prices seems interesting. I personally don't own the stock and am not buying it right now, and you should definitely do your own research before making any investing decisions. For stock number 2, I have the TROW price group, ticker symbol TROW or TROW. This company is also trading at their 52-week low. They just increased their dividend payment, and on a forward-looking basis, they have a 5.42% dividend yield. And kind of similar to Target, this company peaked in 2021, although for different reasons, but in the same economic environment. If you don't know T. Rowe Price, they're an asset manager with a lot of institutional money, and they manage mutual funds. And their core product is actively managed mutual funds. And the economics of that business are pretty good, although a lot of the industry is starting to switch to passively managed ETFs, of which T. Rowe Price is also starting to transition to, but that has lower fees. T. Rowe stock is starting to increase their earnings per share once again and seems to be on a long-term continued growth from that base. They really just had massive outlier numbers in 2021. And as you can see, the stock price just went to the moon. And another reason why it went to the moon is because if we go look at the dividend data, you can see that T. Rowe Price pays these large special dividends every once in a while. That is on top of their regular quarterly dividend that they increase on an annual basis. In June 2021, they paid a $3 per share dividend on top of their quarterly dividend. And that, with their growing earnings, just sent T. Rowe Price into a frenzy. But now we sit at this really depressed valuation. Over the long term, T. Rowe Price has been a dividend growth stock. 10-year compound annual growth rate of the dividend is 9.34%. The 3-year CAGR is 5.55%. However, dividend growth slowed down a lot, down to 1.6% for a few years. And they just announced a new dividend increase, which is slightly faster at 2.42%, but this is still low dividend growth. And on a historical basis, the T. Rowe Price dividend is always in a sustainable range based on that quarterly dividend. You can see it goes up a bit during these years where they have those special dividends. And overall, the financial health of T. Rowe Price as a business is still very good. As you can see, their shareholder equity continues to just grow over time. It's currently at $10.3 billion. They have $2.6 billion in cash and cash equivalents. And as you can see, they build up these large cash cushions, and then that's when they do these special dividends. And the company has basically no debt. Their net debt is currently sitting at negative $2.3 billion, and it's always in a very healthy position. So if we take a look at their balance sheet, I would say we're about a year or two away from maybe being in a territory where they do a special dividend again. And if that happens and the fundamentals of the business continue to improve, then the stock price of T. Rowe Price could maybe finally get some momentum behind it. because this thing has been dead in the water for a few years in terms of stock price. But the valuation is compelling. The consensus price target on Wall Street, even today, is $139. That implies the stock is 48% undervalued. The lowest price target is $113, which is well above the current stock price of $93. I was not even really looking at buying more T. Rowe Price stock, but with this current sell-off, it starts to be compelling once again. In fact, I know a few members of my dividend investing community are buying this stock right now. And if you're focused on optimizing your entry point in terms of dividend yield, so maximizing your current dividend income right now, then this is an attractive time to buy T. Rowe Price stock. This is one of the highest opportunities ever. It was not even this good during the great financial crisis. And over the long term, this has been a great stock to own. Since 1990, the total return is 11,000%. That's even with this poor performance over the past few years. And if we go to the peak price, which was a little bit ridiculous, they had a 22,000% total return. But the real question is whether they get their fundamentals back on track. So let's go take a look at their latest earnings and see what kind of outlook they gave for this year. So T. Rowe Price closed 2024 with $1.6 trillion in assets under management. And by the way, when we're analyzing these asset managers, that's the core metric to look at, because their entire profitability is pretty much based on fees from their assets under management. And when these businesses are doing well, they not only have new money coming in, but they invest to grow those assets under management over time. So there's organic growth that happens just in them investing the money they're given. And if they do a good job of that and continue to collect fees at the same rate, then theoretically the money they make will continue to grow. So the three main levers to look at with these kind of businesses are their assets under management growing? What kind of fees are they getting from their assets under management? Whether that's expected to go up or down, and then whether or not they're able to get more and more money from investors. Now, one of the most negative things with T. Rowe Price's business is that they've had net outflows over the past few years. And basically what that means is they're getting less money in than people are taking out as investors. These are their clients. Now, to be fair, they're still growing assets under management overall because they're investing that money, and the market over the long term continues to go up. So in fiscal 2024, they had $43.2 billion of net outflows. And the positive thing is they've been cutting that down. That's nearly half the net outflows from the prior year. So they're seeing improvement there. And that's one of their big goals. They want to eventually make that positive again. If we look at their outlook for 2025, they said that they're optimistic they remain to be on a path for positive flows and expect 2025 will be better than 2024. Another big thing is their ETF business, which is kind of a growth thing for them. And if we look at their quote from their earnings call, they said they're at $8 billion in assets under management for that. And that's one of the businesses they're seeing actually inflows in. However, this is another lever that's kind of interesting with the company. Their mutual funds, which are actively managed, have a little bit higher fees than their ETF business. But overall, investors are having a preference towards ETFs lately. So that's another pressure point for the company. Another negative is they're expecting operating expenses for 2025 to be up 4 to 6% from 2024. I guess they're moving to a new headquarters. And they didn't mention this specifically on their latest earnings call, but part of the reason why the stock is selling off so much right now is because the market is selling off right now. And the earnings of a company like T. Rowe Price are pretty much based on how the market is doing, because the market going down would lower their assets under management number, because the value of the assets would go down, which in turn would lower their fees. So we'll see if they're able to actually continue growing their earnings per share in the coming years like they were starting to once again. If they do that, then this lower stock price right now would probably be a buying opportunity. One thing I will say is I think this company has very strong financial health, and I think they're pretty much near what their floor is. The big question over the long term is whether or not they continue their history as a growth business, because if they can do that and you buy in at a 5.4% dividend yield, then you could get very good total returns from this price, plus a reliable quarterly dividend payment and these large special dividends every once in a while as well. I have T. Rowe Price in my dividend growth stock portfolio. It's one of my smaller positions, but it's actually my third highest dividend payer. As I've mentioned, I've kind of pivoted to some lower yield, higher growth, and in my opinion, higher quality businesses as well. So I wasn't planning on buying T. Rowe Price, but the cheaper it gets, the more interested I am. I'm definitely keeping my position at these prices, and I'm excited to reinvest my earned dividends. Like, for example, I have a $96 dividend from T. Rowe Price, which gets paid on March 28th. At this current stock price, that gives me one additional share of the company. We'll see if I buy more. I have some other opportunities I've been targeting like Google, Salesforce, Microsoft. And by the way, if we go back to this initial stock screener, I'll share some of the other ones I identified as being interesting opportunities. We have PepsiCo, ticker symbol PEP. They're up 4.8% from the 52-week low. If you want my insights on that, I just made a video the other day going over it. I'll link it in the end screen. I think it was called like top 3 safe dividend stocks during the market sell-off, something like that. ExxonMobil is also on this list, although I don't think it's an attractive buy at the current price because I think the price of oil is going to come down. However, this is one of my top dividend stocks in my dividend growth portfolio. I nabbed it at a great price, so I have a 226% total return. And my dividend yield on cost and from reinvesting dividends is just fantastic. So even though they're at their 52-week low, I don't think ExxonMobil is cheap at these prices. So this is another example of you gotta do a little bit of a deeper research. Just because something's at its 52-week low doesn't mean it's a buy. Other interesting ones I saw on this list were Dow Inc. and this LyondellBasell Industries. I don't know if I said that right. These are 2 very large chemical companies, and they've both seen declining earnings and stock price. But they are reliable dividend payers, and you can see they're up in that 7.5% dividend yield range. So that potentially could be interesting, but I don't really personally know a lot about their businesses, which is why I did not include it in this video. But if we go and look at LYB, what's interesting with them is their high yield and growing their dividend. The 3-year CAGR is 5.85%, and their most recent dividend increase was 7.2%. And as I went through this list, I found a few other interesting ones. I'll end it with this. I didn't even know this company existed, but I found Flower Foods Inc., ticker symbol FLO. They are currently trading 1.7% above their 52-week low, and the current dividend yield is 5.21%. And if we go and look at the stock for Flower Foods, you can see they at least have some reliable earnings that trend upwards over time. This is a lower market cap company too at $3.8 billion. And it turns out this is a sneaky dividend growth company. The 5-year compound annual growth rate is 4.78% for the dividend, and their most recent increase was 4.3%. It's also always sustainable based on free cash flow. They pay out most of their cash flows as dividends, but it's sustainable. And this is a consumer defensive company that owns brands you'll see in U.S. grocery stores. That's a few bread companies, Nature's Own, Dave's Killer Bread. I see them all the time. Oh, they even own Wonder Bread, Tasty Cake. That's interesting. So yeah, this could be worth exploring if you're interested and want that reliable high income. I would not necessarily call this a growth company though. All right, so those are higher yield dividend stocks that are currently trading near their 52-week low. If you enjoyed the video, please leave a like, comment, and subscribe to the channel. And if you want to try out the software I showed throughout the video, it's all available at dividenddata.com. And right now is a great time to join. We have a March Madness sale where you can get 50% off the annual membership for life. And you can try that risk-free with a 30-day money-back guarantee. The link is in the description and pinned comment of the video. With that said, thanks for watching, and I'll see you in the next one.